Hello everybody, this is the first video for Chapter 7 of the Introduction to Quantitative Finance course. I'll have a bit of practice because the first time I recorded this video I was on mute. So this is the second time I recorded. Hopefully I'm gonna improve and do a better performance. So there are three main objectives of this chapter. The first one is to introduce what we call the efficient market hypothesis and the associated assumptions about the rationality of investors when we apply these hypotheses. So the second topic or objective will be to discuss what we call market anomalies, and these anomalies are evidence from market data that tends to contradict the efficient market hypothesis. Okay, so the former hypothesis, efficient market hypothesis, in a nutshell, it assumes that investors are fully rational, they make fully rational decisions, and then market anomalies are evidence that seem to contradict this assumption in some circumstances. And then finally, the third topic is the discussion of behavioral finance, which discusses the biases associated with decision making in finance, because we're all human beings, we're all susceptible to biases. So this impacts the decision making, and we're going to see that such biases can be reasons why we observe the aforementioned market anomalies. So the first video will cover the first two topics, whereas the second video will cover the third topic. Okay, so first thing we will discuss is passive versus active investors. So passive investors are investors who hold portfolios that behave similarly to broad market indices. Such investors do not attempt beating the market, but they are perfectly happy with having a performance that is similar to the broad market performance. Okay, so for example, if they have a portfolio which looks like very much like the S&P 500 index, and they do have exactly the same performance, they will be happy with that. Conversely, you have what we call active investors who are trying to outperform the market by having a different asset allocation in their portfolio than the market index allocation. So a very relevant question you might ask yourself is it worth it to follow active investment strategies and try to beat the market, or should I invest passively and replicate the market performance? So the reason why this question makes sense is because although active investors try to outperform the market, they might not be necessarily be able to do so consistently. And furthermore, active managers of mutual funds, for example, they charge a hefty premium. So the question is, does the performance of active manager justifies charging this premium? Okay, so is the outperformance of active management worth enough to cover the premium they charge and potentially more to earn additional benefits in total in excess of passive investment strategies? Okay, so the value added of active investment has been subject to very heated debates during the last 50 years in the finance community. So people have argued about the value added of active investment, meaning that some people firmly believe you should only do passive investment and active investment is not worth the premium you're paying, whereas some other people are arguing that active investment can have a plus value for an investor. So this debate is highly related to the beliefs of people revolving around what we call the market efficiency theory. So in a nutshell, an efficient market is a market where the price of any asset or security fully reflects what we call its fundamental value. So what is the fundamental value of an asset? Here the definition is given in the footnote and is left pretty vague on purpose. Okay, so here in this chapter will remain very qualitative. We won't give formal quantitative definitions. Okay, so this will remain a bit vague, but this is on purpose because this theory, when it was introduced, it was left a bit vague. Okay, so there are various ways to interpret that. We'll dig deeper into some details later on, but for now, let's have a very stick with the vague definition. Okay, so a fundamental value of an asset is the present value of the cash flow stream provided by this asset, where in the present value, the discount factor should suitably reflect the risks associated with the cash flows. Okay, so for example, if you invest in a stock, then the discount rate should be higher than if you invest in a bond where the cash flows are much less risky. Okay, so cash flows that are more risky have less value, of course, if investors are adverse to risk. Okay, but why I said the definition remains vague is the discount factor being consistent with the riskiness of cash flows. This is vague. Okay, it doesn't tell you how to make the discount factor consistent. Okay, so if we have a fully efficient market, because the price of all assets reflect their fundamental value, it's impossible to consistently beat the market through selecting the various stocks. Okay, so if people think that all stocks are fairly valued, then it's impossible to cherry pick some stocks. Okay, say this one it's overvalued, I'm gonna sell it. This one it's undervalued, I'm gonna buy it, so as to beat the market. Okay, if all securities are fairly priced, there's no way to beat the market. And here, beating the market does not mean simply getting an excess return. Okay, because we saw in chapter 4, for example, that if you want to have a higher expected return than the market, it's pretty simple. You have to take on a lot of risk. Okay, so if you take on a lot of risk, you might have, if you're ready to take a lot of risk, you might beat the market in average by having a higher excess return. But in that case, the outperformance is not a free lunch because you take more risk. Okay, so here beating the market should be understood in the sense that you're more profitable without taking any additional risk. Okay, so if you have an efficient market, all securities are priced fairly, and it's impossible to beat the market consistently just by picking the various stocks because all of them reflect their true value, or the price of all of them reflects their true value. Okay, so the efficient market hypothesis, EMH, is the assumption that financial markets, for example stock markets, are efficient. So by efficiency, we'll have a few versions of the definition of efficiency in the next few slides. But right now we'll stick with the vague definition. Okay, so do people believe markets are efficient? This is a very good question. So first, during the last half of the 20th century, a large part of the financial community, especially academics, or even some people in the industry, they believe that the efficient market hypothesis held. So here there's a quote from a famous economist back then called Michael Jensen, who said the following. Okay, let's read the quote. There is no other proposition in economics that has more solid empirical evidence supporting it than the efficient market hypothesis. In the literature of finance, accounting, and the economics of uncertainty, the efficient market hypothesis is accepted as a fact of life. Okay, so this is a very bold statement. Okay, saying the guy said that this is a fact of life. It cannot be questioned anymore. We've solved this problem by looking at the data, and the markets are efficient. So this was the prevalent opinion by then, during the last half of the 20th century. But since then, the efficient market hypothesis has been strongly debated, and nowadays the scientific literature acknowledges that some facts that were observed are incompatible with the efficient market hypothesis. Okay, so although initially people had very high confidence in the efficient market hypothesis, as time went by, people have questioned the hypothesis, and eventually it became less consensual, and people have identified shortfalls or pitfalls associated with this assumption. So one strand of literature that was very critical toward the efficient market hypothesis is called behavioral finance. Okay, so behavioral finance relies on psychology to identify biases to which investors can be susceptible. So if investors do not behave in a fully rational way, this impacts their decision making, and this might lead to the fact that some securities could be either underpriced or overpriced, and mispricing of some securities might be observed. So there might be a divergence between the market value of a security, which is impacted by the biases in the decision making of investors, and its fundamental value, which reflects what should be the true value of a stock. There are other strands of literature which criticize the efficient market hypothesis, which focused on market frictions. So market frictions are, for example, transaction costs or liquidity constraints, or they're constraints that prevent investors from behaving fully to exploit what they could perceive as mispricing. So what's the main message in that strand of literature is sometimes there might be some mispricing of securities. So maybe the pricing of two securities might be inconsistent with one another. But when trying to exploit this mispricing, this requires doing transactions, and the costs of such transactions might be larger than the benefit stemming from the exploitation of the mispricing. Okay, so if the costs are higher than the benefits, in that case it's not worth it to try to exploit it, which means that the mispricing might remain. So we see that the efficient market hypothesis in recent years, it was a bit more criticized, and there were reasons that were provided why it would not systematically hold. So now we're going to discuss a few forms of the efficient market hypothesis. Okay, so the definition at the beginning was left vague, but now we're going to make it a bit more precise by providing three different versions of the efficient market hypothesis. The first version or form is the weak form of efficient market hypothesis, which assumes that the information provided by previous asset prices is fully reflected in the current prices of an asset. And what we mean by that, we mean that it's impossible to consistently beat the markets simply by analyzing historical prices of stocks or assets. Okay, so it's impossible to just look at previous prices of a stock to infer its future behavior. or like future, let's say, it's impossible to look at past prices to determine if it's going to go up or down or by how much. So this is the first and weakest form of the efficient market hypothesis. The second form of the hypothesis is the semi-strong form. Okay, so the semi-strong form of the efficient market hypothesis, it assumes that not only information related to previous prices is factored in the current prices of assets, but also all public sources of information are reflected in current asset prices. So, for example, if somebody believes in the semi-strong form of efficient market hypothesis, then it would be impossible for an investor to simply look at financial statements or public financial news or other public sources of information to be the market. Okay, so all this information is already heavily scrutinized by analysts, which uh, which trade the various stocks. So the stock prices should already reflect such information. A consequence of this would be that in a market that is that satisfies the semi-strong form of the efficient market hypothesis, then prices should immediately react to news. So as some news becomes public, let's say to a merger of two companies or something like that, prices should react immediately to the news so that investors cannot exploit the news to profit from stock trades. And now there's the third form, which is the strongest of all three forms of efficient market hypothesis. It's called the strong form of efficient market hypothesis, and it assumes that not only public information, but also private sources of information and thorough analysis made by companies and experts are already reflected in prices of assets. So the consequence of that last hypothesis, if it's satisfied, is that there would be no good or bad investors, only lucky ones. Okay, so it's impossible to, if you believe in the last form of the hypothesis, it would be impossible to find any source of information relevant to be the market, because if there existed such source of information, somebody somewhere would already have analyzed it and profited on it if there were mispricing, so that the market already reflects the source of all private sources of information. Okay, now we've outlined the three forms of efficient market hypothesis, but in practice these are not binaries. Okay, so it's not either it's respected or it's not respected. In practice, first, not all forms of efficiency might be satisfied at the same time. So it might be the case that some market is weakly efficient but not strongly efficient. Or there's also the fact that inefficiency, it's not a 0-1 binary type of behavior. It can be mildly efficient, very efficient, extremely inefficient, etc. Okay, so it's more a spectrum of efficiency rather than simply being efficient or not being efficient. So what we will do next is we're gonna discuss evidence and studies that either support the efficient market hypothesis or tend to infirm the theory. In what follows, we'll only cite a few studies instead of studying a very large number of them, because you could have courses like 4 months courses fully dedicated to this topic. So of course, this is only a part of a chapter in the current course, so we'll only cite a few just to give you examples of analysis that were made with respect to this efficient market hypothesis. But in practice, there's much more that was done. So if you're interested about that, there are tons of reference about the topic. Okay, so let's start with the first form of the efficient market hypothesis, which is the weakest form. So many studies, and by many I mean many studies have applied statistical tests to try to determine if there are predictable patterns observed in stock prices. So, of course, this is a highly interesting question for investors, because if there are predictable patterns, then the investors could exploit them to make profits. So investors would be very interested in learning about such patterns if they exist. So historically, at least in the early stages of tests about this hypothesis, many statistical tests were white noise tests. Okay, so here white noise tests will not be described in full details, but if you do the time series class, for example, these type of tests are discussed. So in a white noise test, one tries to determine if the evolution of the price of a stock, if it behaves randomly without any predictable pattern, or if there are predictable patterns in the price of stocks. So in terms of types of patterns, one possible pattern would be what we call autocorrelation or serial correlation, where returns of a stock in a given period are correlated either positively or negatively with the return in a previous period. So this we will discuss in the next slide. Okay, so and a very early study that was done by Kendall in 1953. He took the price history for many stocks, calculated serial correlations, and found that they were very low. Okay, so because of the low correlations, the author deemed that stock prices, they behave pretty much like a random walk. Okay, so serial correlation, let's explain that. So if there's high serial correlation, it means that a positive return is typically followed by another positive return, or a negative return is also followed by another negative return. So if you have these types of patterns, well, as soon as you observe a positive return, then you might want to buy the stock to benefit from the likely next positive return, and etc. So we can see that if there are correlations or these type of patterns, then these could be exploited for profit. But Kendall here he claimed that by looking at the stock prices time series, such correlations are very mild, and they cannot necessarily be exploited because the non-zero correlations might only be so small that they're due to noise, for example, or randomness. In a more recent study, Brealey, Myers, and Allen in 2017, they drew scatter plots for the return on a stock on a given day versus the return of a stock on the previous day for many stocks and for a large time horizon. So the data set covered 23 years of data. And they tried to look for pattern of the return of a given day versus the return of the previous day, and they didn't identify any clear pattern. Okay, so they didn't identify no tendencies for what we call momentum. So momentum is positive serial correlation, where positive returns are typically followed by other positive returns, so that you have kind of either a continuous upward movement or a continuous downward movement of a stock. But they didn't find any momentum, and they didn't find any obvious reversals. So reversals, it's the opposite. It's when the market systematically corrects itself. So after a positive return, it tends to go down, or after a negative return, it tends to go up. So again, if there were these types of reversal, these would be predictable patterns which could be exploited for profit. But the authors showed that it's not obvious that such patterns exist in practice. So these studies, the Kendall one and this one, they provide evidence that tend to support the efficient market, at least the weak form of efficient market hypothesis. Now, there were other studies which tended to support the semi-strong form of the efficient market hypothesis. For instance, there's the study of Keown and Pinkerton, which studied the return on the stocks of companies right before and after a merger is announced. Okay, so let's say two companies merge together. This should have an impact on the price of the stocks. So the authors, they looked at price of the stocks of the two companies before the merger is publicly announced and right after the merger is publicly announced. What they've identified is tendencies that before the merger is publicly announced, the returns tended to be abnormally high for some time period. Okay, so this indicates information leakage. So some investors, they profited from the private information about the merger. But then what they've seen is that once the merger is publicly announced, abnormally high returns tend to disappear. So the returns become more regular and there's no such pattern occurring after the merger has been announced. So this evidence, it seems to be consistent with the semi-strong form of efficient market hypothesis, but probably not with the strong form of efficient market hypothesis, because this would entail that some private information about stock prices or about the companies could be exploited, but not the public ones. Okay, so whether it's legal or not to exploit these information in these contexts, well, I don't know. But this is what the study tended to indicate. And now finally, some studies even supported the strong form of the efficient market hypothesis. So for example, there's the study by Burton Malkiel in 1995, which investigated the performance of active managers, for example, of mutual funds, between the period ranging from 1971 to 1991. And what he observed is that the top-ranking active fund managers in 1 year only roughly had a 50% probability to beat the market in the following year. So this tends to indicate that managers which were very good in a given year were not necessarily very good because they had extremely good skills, but rather simply because they were lucky, because their performance was not persistent through time, and in the next year their performance was half of them, their performance was equal or smaller than the market performance. So this seminal paper, it led many investors and people to switch to passive investing because it shed some doubts about the plus value of active management. Okay, so a lot of active managers seem to gain outperformance in some years due to luck, but their performance could not be repeated consistently in upcoming years. So these studies pointed to evidence about which do support the various forms of the efficient market hypothesis, but there's also multiple studies that have been done in more recent years documenting evidence going against the efficient market hypothesis. Okay, so because of that, of these more recent studies of which highlighted violations of the hypothesis, the prevailing opinion about the efficient market hypothesis in the academic community has gradually shifted over time. Okay, so we said that in the second half of the 20th century, a lot of people were convinced that markets are typically efficient, but as time went by, some people have criticized the efficient market hypothesis. Studies have been done which identified facts or outcomes incompatible with the market efficiency efficient market hypothesis. So this shed some doubt about the validity of the hypothesis under certain circumstances. So the violations that were identified uh, violations of the efficient market hypothesis that were identified are referred to as market anomalies. So next, what we will do is we will review a few of the market anomalies that were identified. So we're first type of anomaly that was identified by some researchers is calendar anomalies. So calendar anomalies represent situations where stocks they have a higher average performance in some given time periods of the year or of the week in comparison to other time periods. So for example, the first of such calendar anomalies that was identified is the January effect by Thaler in 1987. So this study highlighted that stock returns tended to be much higher in January than in other months of the year, especially for small stocks and stocks whose price has declined substantially in recent years. So the literature has attempted to explain this effect in a few ways. There might be explanations about this is irrational and it cannot be explained through rational means, but there were other rational uh, uh, explanation based on rationality, which is that these effects could maybe partially be explained about tax effects. So if you sell a stock before December 31st, it's treated differently than if you buy it or sell it after January 1st. So this might explain why in January there's a different behavior for the price of stocks. This might be due to tax effects. But again, I'm not an expert in this January effect. You can have a look at the literature. Now, one thing is, once some anomalies are observed and documented, sometimes they tend to disappear. Okay, because as people became aware of the January effect, then some investors have exploited this and they purchased stocks right before January to benefit from the excess return in January. So because of that, as these anomalies become documented, they become exploited, and therefore they tend to disappear. Okay, so anomalies are not something static through time. They might appear and disappear as people realize that they exist. It's the same thing for arbitrage opportunities. Okay, so when there's an arbitrage opportunity, eventually somebody somewhere, an investor, will realize it exists, start exploiting it, and the arbitrage opportunity would disappear eventually. The second type of calendar anomaly that was documented is the weekend effect. So here, these two authors, they observed that stock returns tended to be lower on Mondays than during the other days of the week. Okay, so again, is there a rational explanation for this, or is it just simply irrational and incompatible with market efficiency? Uh, it's hard to say. But let's point out, we can point to the fact that it's hard to reconcile this fact with uh, the market efficiency hypothesis, uh, because it seems to indicate that, that there's some predictable patterns about stock prices. So um, another anomaly that we should discuss is market underreaction or market overreaction. So these situations are they describe uh, outcomes where participants they incorrectly factor in new public information made available to them when they're pricing the stocks, or when they're deciding at which price they would trade the stock. Okay, so uh, what's underreaction? It's when the investors they don't react enough to the news, public news going out, so the price variation observed in the market is too small with respect to what it should be if it was priced rationally. Okay, so the initial reaction might be too small, and because of that, the entire reaction will be spread through time. So there might be patterns where when the news goes out, there's a small movement, but this movement will continue over a few days or a few weeks due to uh, the initial reaction, which was not sufficient in magnitude. Conversely, there's the other possibility, which is overreaction. So overreaction is when there's a news that goes out publicly, but investors they might panic or become overly enthusiastic, and the price changes in a very drastic way, which cannot reflect rational variations of the price. Okay, so overreaction is where investors they have a reaction that is too large, and eventually the price will correct itself to revert to a more rational level. So people might be wondering, are people overreacting, underreacting to news, or reacting rationally? This has impacts on decision making, because if you know markets are overreacting, uh, you could exploit this information to be the market. So for example, if you know that whenever there's a bad news, the stock prices they go down by way too much and they tend to go back up after a while, then you might want to consistently buy stocks when there are crashes or something like that. Okay, so if there's systematic underreaction or overreaction, you should be able to exploit this information to beat the market. So have some studies discussed this question about, do investors under or overreact? The answer is yes. So in the first seminal paper, Robert Shiller, he argued that investors are overreacting with respect to the change in their expectations about dividend stream. Okay, so in this paper, the author argues that the stock price volatility is much higher than what it should be if investors were rational, and it cannot be explained by the variation in the expected present value of discounted dividends. Okay, so as we said, the fundamental value of a stock should be the present value of all its cash flows, which are dividends, and the author provides a model and argues that the current level of volatility, it's, as we said, it's the standard deviation of the return. It's way too high for in comparison to what it should be if the stock prices did reflect their fundamental value, because the the volatility of the expected present value of dividends is much lower than the volatility of the stock price itself. So this study tended to indicate overreaction, which is incompatible with the efficient market hypothesis. A second study, which also pointed to failures of the efficient market hypothesis, is the study by Bernard and Thomas in 1990. This study relates or discussed what we call post-earnings announcement drift. Okay, so here I'll give the definition provided by Wikipedia of this post-earnings announcement drift. Wikipedia says that for firms that report good news in quarterly earnings, their normal security returns tend to drift upwards for at least 60 days following their earning announcements. Okay, so this says that there was a tendency, at least in the data set used by Bernard and Thomas, there was a tendency for when good earnings are reported by a company, instead of having a swift adjustment of the stock price and then behavior according to a random walk, instead there was like a small adjustment of the price, and then the price continued drifting up for 60 days after good earnings were announced. And this is incompatible with the efficient market hypothesis because and the semi-strong form of EMH, because if the latter held, then as soon as good earnings were announced, there should have been a sudden change of the stock price and then subsequent random walk movements. So there's no predictable pattern exploitable by investors in that case. Similarly, their study found that for firms that reported bad news in their earnings, instead of having a sudden downward adjustment of their price, there was a downward trend in the price over a 60 days period or a similar period. So this indicates also the presence of predictable patterns in stock prices after good or bad news in announcements about dividends, or not dividends, but earnings were made. Okay, so this is another study which seems to be in contradiction with the semi-strong form of efficient market hypothesis. Then another market anomaly that we will discuss is called the Siamese twin stocks anomaly. Okay, this is a very weird situation documented in the paper of Rosenthal and Young in 1990. So back then there were two major oil companies called Royal Dutch and Shell, which merged together, and they made an agreement that Royal Dutch would own 60% of the merged company, whereas Shell should own 40% of the total company. So this should imply that the sum of all the values of all shares of Royal Dutch, so the market capitalization of Royal Dutch should be worth 1.5 times the market cap of Shell, because 60% over 40%, it's 1.5. However, when looking at shares price, there were persistent deviations from this ratio that was observed. Okay, so this fact is this outcome is very hard. It's very hard to explain it from if somebody believes in the efficient market hypothesis. Okay, so this clearly seems irrational, and it seems to contradict the efficient market hypothesis. Okay, so in the next video, we will discuss why are such anomalies observed in practice. So we won't give definitive answers, but at least possible reasons why market anomalies can be observed in practice and persist through time. Now, before we end this video, because the what follows, we will do it in the second video. But before we end this video, I just want to say something. Whenever there's a study, so we've presented many studies here to either which either tend to infirm or confirm the market efficient market hypothesis. Whenever you run across a study, please don't take it as the ultimate definitive truth. Every time there's a study, the authors, they use some methodology, they use a given data set, they use specific tests, but all these can be criticized. Other authors could have followed other methodologies with different data sets doing different tests. So answers provided by these studies should not be seen as something definitive, but still, and it's still relevant to continue questioning them. Okay, so this is the scientific process. We don't have definitive truths, but it's important to continue question the results that are provided by papers, studies, and the scientific literature. Because, for example, if people stopped questioning what the state of the art science said, people might still believe in efficient market theory and believe that it's a definitive fact. But we've seen that although studies can point in some direction, it might not be the case forever. So it's very important to have a critical judgment when you read these studies and not to rely blindly on their results if you want to do investing or use them for other purpose. All right, so I'll see you next time for the second video of this chapter. Take care.